Okay, so I did the last video on determining market direction, basically the difference between trend and bias and why bias is more important. And if you didn't see that video, I'd go back and take a look at it. It's 8 minutes long, but the gist is, the basic idea is that in a non-trending market, you need to determine what the bias is so that you don't buy the highs and sell the lows. Today, what I want to talk to you about are buying and or buy and sell zones. Everybody's heard the adage, buy low and sell high. And in the futures market, of course, you can sell high and buy low. Uh, but what does that really mean? I mean, you got to know when to do it. And what I'm going to talk to you about today is going to be, it's just a little bit of a different deal. It's nothing new. I mean, it's nothing major, but it does made a difference for me, and so hopefully it'll help someone else. It'll help you out. Um, so on the chart, what you're looking at is just a candlestick chart, and all I have on there is a Keltner channel set at a 1 standard deviation. We're going to look at an uptrend, a downtrend, and we're going to look at some congestion, and then we're going to look at some areas that you got to be careful of. So the idea is very simple. You create these zones by use of the Keltner channel that you're going to buy and sell at. So we'll just go from left to right. So here you have in a downtrend, you've got a market that's trending down, and then it bounces up and touches what I call the sell zone. You're going to sell at the top of the market in a downtrend. You're going to buy at the bottom of the market in an uptrend. So really quickly, very simply, and there is more to this, so don't get me wrong, I'm not saying that you can just go out there and just buy and sell these things, but once you've determined that this is the downtrend, this is your area of opportunity to short the market. You would not do so unless you had confirmation, though, and those are other videos. But so this is an opportunity to go short. Obviously, if you just shorted here, you would have taken a loss. But now you're in an uptrend here. When these pullbacks occur, those are the times that you're looking to go long. And ideally, you would have liked to see these hit the zones, or the buy zone, what I call the buy zone here, which it did here. And you pretty much go out to the other zone as far as an expectation on profit. Again, you use other things to determine how long you can stay in and when you need to get out and so forth. So we've got a downtrend, we have an uptrend. Basic idea is buy at the bottom band in an uptrend, sell at the top band in a downtrend. Now you move into congestion, and this is where it works out really well, because you have congestion, and then this is telling you, okay, you're gonna sell here, you're gonna buy here, sell here, buy here, sell here. Obviously, then you eventually you're going to break out. Again, you've got to use other confirming tools and so forth. But within the trend, once you've defined what that trend is, this is what you want to do. So here you have a downtrend, and you want to, when price pulls up to that mid-band area or that other buy zone area, or excuse me, a sell zone here, this is where you would like to short the market. This is where you would like to short the market. The idea is that if you get a pull up and confirmation by way of other things that you do, and we'll talk about those in other videos, that's then your system and rules should tell you that that's when you should short or when you should go long, whatever the case may be. Here's another situation. If everything else told you to go short, then you go short, and if it turns out to be wrong, you exit somewhere in here probably, and no harm done. So that's the gist of it. A very simple concept, but again, what I'd like to do here is be able to provide some ideas. The overall idea is, in an uptrend, you want to use something to determine where that bottom is to buy, and in a downtrend, when price bounces up, you want to catch it in that up state, not on the resumption of the trend down. And there are obvious reasons for that. So I know it's a quick look. Hopefully it'll get some discussion going, and certainly you can take this and run with it. For example, you can use this for the overall look of the market, and then drop down to a smaller time frame chart and really dial in for those entries. For example, here, you could this is a 220 tick chart. You could look at a 55 tick chart and catch this bounce up, and it would look completely different. Hit a top sell zone, and you'd be on your way. And a lot of different things you can use to play with that. But the old, here's a downtrend. You want to sell high and buy low. This is a way to identify a good opportunity area to find a good entry point for a short. Same thing on an uptrend. You see it in this fashion. It's pulling down. Somewhere in here is where you want to find a buy. That's what you're looking for. Something like this. So you'd have to play with the with the deviations, make them tighter. Obviously here this touches more, this touches, then this touches, and so on and so forth. So anyway, hope that makes sense to you. And as always, I welcome questions. I will try to get to them. And again, if you have a beef with anything that I'm saying, tell someone else. I'm not interested. I only want productive conversation going on here if it's something that's going to help everyone. With that, I'll catch you guys later.